upward. The next candle shows the same thing. Then the next one again. Session after session, buyers continue to dominate the market. When we see many candles moving in the same direction like this, we call it a trend. In this case, it is an uptrend, which means buyers are controlling the market. But then something interesting happens here. Look at these two candles. The first candle is bullish, meaning it opened lower and closed higher. But the second candle opens above the closing price of the first candle, and then suddenly moves down and closes below the opening price of the first candle. When this happens, the second candle completely engulfs the previous one. This forms what we call a bearish engulfing pattern. What does this tell us? It tells us that buyers were previously in control of the market, but now sellers have taken control. And when this kind of shift happens after a strong upward move, it can signal that the uptrend may be ending and a new downtrend could begin. So, as you can see, even with this small amount of knowledge, you can already start understanding where the market might move next. But this is still not enough to become a complete chart analyst. That's why you should stay until the end of this video, because what you're about to learn next will completely change the way you analyze the market. Now let's look at the opposite scenario. Here we see multiple red candles, which tells us that sellers are in control of the market, creating a downtrend. But then we see the formation of a bullish engulfing pattern. This pattern shows that buyers have stepped in strongly and completely absorbed the previous bearish candle, and this often signals a possible reversal, where the market may start moving upward instead of downward. Now let's move to another important candlestick pattern called the harami. The word harami comes from Japanese, and it means pregnant. It has this name because the pattern looks like a small candle inside a larger candle, just like a baby inside the mother's body. The harami pattern is made of two candles. The first candle is usually a large candle, showing strong movement in one direction. The second candle is much smaller, and it forms completely inside the body of the first candle. This change in size is very important because it tells us that the momentum of the market is slowing down. In other words, the side that was previously controlling the market is starting to lose strength. And during that specific period of time, the market is no longer moving strongly in one direction. Instead, it begins to enter a state of pause, or what we can call a small range. That is why, when we spot a harami pattern, we can draw a line above the highest point of the mother candle and a line below the lowest point of the mother candle. These two lines give us the range boundaries of that specific period, and this is very useful because it helps us understand what the market may do next. As we said, the harami pattern indicates equilibrium. It shows that the market is pausing, and neither buyers nor sellers are clearly in control at that moment. But this pause does not last forever. If the market later breaks above the range of the harami, this tells us that buyers have taken control again and the market may continue moving upward. On the other hand, if a new candle forms and breaks below the lower boundary of the harami range, this tells us that sellers have taken control and the market may start moving downward. So the harami does not only show us that the market is pausing, it also gives us a clear framework to understand where the next move may begin. Now let me show you a real chart example. As you can see here, we have 4 green candles, and as you already know, green candles tell us that buyers are in control of the market. Then a harami pattern forms. This tells us that buyers are no longer pushing the market with the same strength. They were driving the market higher, but now the market is pausing and we need to wait and see what it decides to do next. Now look at what happens. Another candle forms and breaks above the harami range. This indicates that buyers have taken control again, and the market is likely to continue moving upward. So as you can see, by understanding the psychology behind the harami pattern, you can already begin to anticipate what may happen next. Now look at another example. Here we have multiple red candles forming. This tells us that sellers are in control of the market. Then a harami pattern appears. This indicates that the market enters a range during that specific session. For example, if you are using the 15-minute chart, you could say, the market was trending downward, but during the last 30 minutes, it entered a pause, and now it is ranging. At this point, we do not yet know what the market will do next, but then something important happens. Another candle forms and breaks below the harami range. This tells us that the market is not changing direction. After a pause, it may now continue moving downward. So once again, the harami pattern helps us understand when momentum is fading, when the market is entering equilibrium, and when a new move is starting. As you can see, even with this small amount of knowledge, you are already starting to read a chart like a language. But this is still not enough. You still need more concepts to fully understand how the market works. And that is exactly what I will teach you in this video, step by step. So stay with me until the end. Now let's move to the next candlestick pattern, called the Morning Star. The Morning Star is a 3-candlestick pattern that often signals a bullish reversal in the market. In simple terms, it shows us that control of the market is shifting from sellers to buyers. Let's break it down step by step. The first candle is a long bearish candle. This candle shows strong selling pressure, meaning sellers are clearly in control of the market. The second candle is much smaller. It can be bearish or bullish, but what matters is that it reflects indecision in the market. After strong selling pressure, the market suddenly slows down. This candle tells us that sellers are no longer pushing the market with the same strength. Then comes the third candle. This is a strong bullish candle that closes well above the midpoint of the first candle. This shows that buyers have stepped into the market and taken control from sellers. So when we read this pattern, the story becomes very clear. The first candle shows seller power. The second candle shows indecision. The third candle shows buyer strength. And this shift in control often signals that a bullish reversal may be starting. Now let's look at a chart example. As you can see here, we have multiple red candles in a row. As we explained earlier, red candles mean sellers are in control, so the market is clearly trending downward. But then the Morning Star pattern forms. This pattern tells us that sellers are no longer dominating the market. Instead, buyers have stepped in and taken control, which means a reversal may be about to happen. Now let's look at the opposite version of this pattern, called the Evening Star. The Evening Star is also a 3-candlestick pattern, but this time it signals a bearish reversal. The first candle is a strong bullish candle, showing that buyers are controlling the market. The second candle is again small, reflecting indecision in the market. The upward momentum begins to slow down. Then comes the third candle, which is a strong bearish candle that closes well below the midpoint of the first candle. This tells us that sellers have entered the market and taken control from buyers. So once again, the story becomes very clear. The first candle shows buyer strength. The second candle shows indecision. The third candle shows seller power. And this shift in control often signals that the market may begin moving downward. Now let's move on to the next candlestick, the Tonkachi. The word Tonkachi comes from Japanese, and it means hammer. This pattern gets its name because the candle looks like a hammer, with a small body at the top and a long lower shadow. This candlestick represents a conflict between buyers and sellers during a specific trading session. At the beginning of the session, sellers push the market downward. They manage to move the price lower and appear to be in control of the market. But then something important happens. Buyers step in and begin to resist those lower prices. They push the market back upward, rejecting the move created by sellers. By the end of the trading session, the candle closes near the top, leaving behind a long lower shadow. This final shape tells us something very important. Even though sellers were strong at the beginning, buyers eventually won the battle during that session. Because of this shift in control, the Tonkachi is often considered a potential reversal pattern. Now look at this chart example. Here we can see that the market is clearly trending down, which means sellers are dominating. But then a Tonkachi candle forms. This candle shows that sellers tried to push the market lower again, but buyers strongly rejected those prices and pushed the market back up. This rejection of lower prices indicates buyer resistance first and then buyer dominance. And when this happens after a strong downward move, it often signals that the market may be preparing for a reversal. Now let's look at the opposite version of the Tonkachi, called Nagaraboshi. The word Nagaraboshi comes from Japanese, and it means falling star or shooting star. This candlestick has the opposite shape of the Tonkachi. It has a small body at the bottom and a long upper shadow. Just like the Tonkachi, this candle represents a battle between buyers and sellers during a trading session. At the beginning of the session, buyers push the market strongly upward. They manage to drive the price